Hi everyone, my name is Russell Jude. I head up a company called Edge Designations, where we offer prep services for the CFA, FRM, KIA, and FTP designations. For more information about our services, take a look at our website, www.edgedesignations.com. This particular video is the sixth and final video in our series of how to use your calculator, the Texas BA2 Plus calculator or the Texas BA2 Plus Professional. Both of them are handled in our videos as both of their functionality is the same. For those writing CFA, FRM, and KIA, the Texas Instruments is probably the most commonly used calculator. There are others that are allowed as well, but the Texas is the most commonly used one in my opinion. And based on that, that's why we have decided to do all of our videos, all of our calculator work related to CFA, FRM, and to KIA. We've done this based upon the Texas calculator. Of course, no disrespect intended to any of the other makers as well. This being the final video, please do have a look at our earlier videos as well, where we have covered from the beginning. Video number 1, we handled the setup of the calculator. Video number 2, we looked at time value of money. Video 3, we looked at cash flows, internal rates of return, and net present value. We looked at interest rates in video number 4, particularly the interest conversion function. Video number 5, we looked at loans and the amortization function. And this last video, which is an interesting one, an enjoyable one, is on bond valuation. What you'll notice about this particular video, it's not so well suited really for calculator work. What I'm just trying to illustrate in this particular video is how we use the calculator to value bonds, albeit that it's not the best way to value bonds, the easiest way, because what we find is that bonds, particularly when we value them on a spot basis using spot rates, we've got different rates for different cash flows, which makes use of the calculator not so efficient, still more efficient than doing it manually, but there's no real quick way of doing these particular calculations. In addition, we just wanted to teach everybody a little bit about bonds as well, which of course is a bit of a passion that we have. Okay, let's get ourselves going straight away. And if you look over here on top of the page, we are starting off with bond valuations. Very important when we do bond valuation, just a little bit of an intro into bonds. There are 3 rates that we always work with. We work with par rates. Par rates are called average rates. We work with spot rates. Okay, and we will also work with what we call forward rates, rates into the future. Okay, when we look at bond valuation, okay, the most correct way of valuing a bond if we've got future cash flows is to discount those particular cash flows at the spot rate. The spot rate is really just a rate that we would discount 0 coupon bonds at for those particular maturity periods. So for example, and it's important to notice is that we would always use a different rate, for example, per maturity when I'm discounting my future cash flows, because remember, the risk on those cash flows is different for the various periods. The risk on a 1-year cash flow is different to a 2-year, different to a 3-year, etc. As such, the cash flows relating to those particular periods deserve different rates. Remember, of course, the rate, the spot rate, which is what we're going to be using, is really just a compensation to the investor for investing in those bonds. So different risks, different returns for different periods. Okay. Unfortunately, the calculation, yes, we can use our calculator for this, and yes, we must use our calculator for this, but still it's a fairly manual procedure. Okay, let's have a look at it. And let's just make sure we are familiar with the process. Okay, I'm looking at bond valuation, and what I'm looking at specifically over here are discrete interest rates. What's the difference? And we've spoken about this in our previous videos. What is the difference between discrete and continuous interest rates? Discrete interest rates are interest rates at a particular point in time. Okay. And discrete is like, for example, if we say, well, for example, a loan, an investment is compounded monthly. Well, we've got 12 discrete periods, haven't we? When we talk about continuous compound, we talk about it as compounded all the time, continuously. And of course, as mentioned previously, for continuously compounded calculations, we make use of logarithms and exponents. We'll look at that one in a second. Okay. Let's do this by way of example. A bond has a coupon rate of 5%. Remember, a coupon rate is the amount that the bond pays its bondholders or investors at, and a maturity value of $100, 2 years' time. Okay, what does all of that mean? That means if I'm looking at the cash flows, the coupon rate of 5% means that this bond will pay coupon of 5% per annum based on its maturity value. There's many different words for maturity value, redemption value, face value, all those kind of things. And that's the end value that the bond pay. Also, the future value of as well is that $100 amount. So if I'm looking at the cash flows on this bond for its 2-year period, year one, it's got a cash flow of $5. Why? 5% times $100 maturity value or future value or redemption value. Year two, 105. Why? Because it still pays the coupon of 5% for that year, the $5. But remember, all bonds repay their nominal, the face value at maturity. In our example, that is $100 at the end of the second year. There are our two cash flows. What do we know about bond valuation? Bond valuation, very similar to discounted cash flow valuation for equities. That the bond valuation, all that we do over here is we take our cash flows, there they are in year one and year two, and we present value them to today's date. What does that tell us a little bit? That tells us that the value or the price of a bond is its present value. So the minute you can get the present value of a bond, you've got its price. What is the present value? Well, we look at the future cash flows and we discount them back to today's date. But remember, the most accurate way of doing that is to use spot rates, the rates that relate to the particular zero coupon bond for that particular cash flow for that particular year. Okay, so year number one, I've got 6.7%. So what am I going to do to value my cash flow on my bond for year one? I'll take my $5 over there, discount that at 6.7%. What will I do for my cash flow of 105 in year two? That one I'm going to discount at the year two rate, spot rate of 7.1. And what do you notice? The spot rates for the different years are different. Of course, they're different. And the reason that they are different is because there are different risks related to this bond depending on the period to which they relate. Okay, as mentioned, yes, I'm going to do some present value calculations. Unfortunately, still a little bit time consuming. There's no real quick route to do these kind of calculations when I've got different interest rates. I've got to do them one by one. Let us have a look over here. We start off my calculations, of course, clear my screen, get ourselves nice and ready over there. I put a 1 first. Why do I use a 1, number one? Because it's cash flow for year number one, and input that in over there. I then go 6.7, which is my interest rate for year number one, the spot rate for year number one. Input that as IY. Remember again, I don't put 6.7%. I put it as a whole number of 6.7. I'm boring you now. I know we've told you this many, many times. Okay, and there we've got that rate over there. In this particular calculation over here, I'm going to put 0 for my payment. Why am I putting 0 for payment? You say, but isn't there a payment of 5? There is a payment of 5. I'm going to treat that 5 as my future value, because remember, that payment of 5, yes, all that is a payment, is a coupon payment. When does it happen? At the end of the period. And I'm only doing one period at a time, so I can treat that $5 as a future value. I go 5. Don't forget to put it as a minus. I keep all my future values and my payments as minuses. Remember, keep the sign the same for both future values and payments. distinct from that of present value. I'm going to go 5 future value. There we go. Don't forget to push CPT. Now I want to work out what is my present value. Compute present value. And what do you notice? That the present value of this particular cash flow is 4.68. Now, let's just try to analyze that for a second. What does that all mean? That means that if I'm going to receive a coupon payment on this bond of $5 at the end of year one, what's its present value? What's it worth at the beginning of year number one? 4.68. And that's the first component of my present value calc for my bond. But remember, there was a second cash flow as well related to this particular bond. Let's go and look at that second cash flow now as well. Let's clear my screen, second function, clear all my time value of money. There we go. Let's get going now on the second cash flow. So let's go. I go to N, why 2N? Because now I'm working with the second cash flow. The second cash flow, remember, has a different interest rate to that of the first cash flow. This cash flow has got an interest rate of 7.1. Remember, when you're valuing cash flows, the most correct way to do this for bonds is to give the correct interest rate, or called spot rate, for each particular year, each particular maturity. So I'm going to go 7.1 interest rate. Remember, we put that in as a whole number. Okay. Again, I'm going 0 for payment. Why? Because what I'm going to do over here is I say to myself, well, I've got a final cash flow of how much? 105, made up of $5 coupon, $100 face value or future value. I want to treat that all as a final payment made as a future value, as my cash flow that I'm going to receive at the end of year number 2. So let's put that in of 105 negative future value, and let's compute the present value, CPT present value, and I get to a number of 91.53. Again, what does all of that mean? That means that if I've got a future value of 105, in other words, I'm going to receive $105 at the end of year number 2, and I've got an interest rate of 7.1% for year number 2, a spot rate related to year 2 of 7.1. What is its value at the beginning of the year, of years at time period 0? That's worth $91.53. That is its present value. Okay, now I'm coming to work out the value of my bond. The value of a bond, or the price of the bond, okay, is really the present value from year 1, which I did on my calculator to get to 4.68, plus the present value from year 2 of 91.53. Sum those two together, and I get to a bond value of 96.21. In other words, if someone had to ask, what would you pay for a bond that has got these characteristics? A spot rate of 6.7 in year 1, 7.1 in year number 2. Okay, a face value of $100 at the end of year 2, and a coupon payment of 5% per annum. Oh, for such a bond, I would pay $96.21. Remember, just something so important as you go through your CFA, FRM, KIA journeys, okay, that the price stroke value of a bond, I'm using it a bit interchangeably, okay, bear with me, okay, is equal to its present value, okay. And we know now how to calculate present value. Where it becomes a little bit challenging is that when there's different rates, like there should always be when you're valuing different cash flows on a bond, we use the spot rates. Those spot rates differ year on year, maturity on maturity. The calculation becomes a little bit manual. Okay. We move on over here, and I want to do the next. What happens, and really just a bit of an illustration to you more than anything else, is what if I use different spot rates? And now I'm using my valuation with what we call a continuous rate. Now, remember, we've spoken about continuous and continuous compounding in the past. And what did we say? When anything is continuous, we then need to make use of exponents and logarithms. But remember, the underlying methodology to value a bond, in other words, that the value of a bond is equal to its present value, that doesn't change. So what I've given you over here is exactly the same carbon copy. Let us have a look. Okay, I've got a bond with a rate, it's got a coupon rate of 5% with a maturity or face value of $100. Again, 2 years' time. Now they've given me continuous discount rates, 6.49 in year one, 6.86 in year number two. Okay. How do I value a bond? Well, I say, what are my cash flows? Well, my cash flow in year one is a coupon of $5 times its face value of 100. And in year two, a coupon of $5 times its face value of 100 is $5. Don't forget to add in the face value, maturity value, redemption value, future value of $100. That also needs to get repaid at the end of year number two, giving me a cash flow of 105 in year two and $5 in year number one. I need the present values. Now, the present value calculation when I'm using continuous rates is a different calculation. Okay, look what it is now. Okay, present value is equal to future value. So we know what my future values are. It'll be $5 cash flow in year one. It'll be $105 in year number two times E, the exponent, to minus RT. Wow. Okay, what's minus RT? Minus R is minus the rate. The interest rate will be 6.49 or 6.86, and T will either be 1 in year one and 2 in year number two. And what I'm really trying to show you over here, guys, is when you're working with continuous rates, FRM does this a lot more, Kaya as well. CFA not as much, but could come up as well. When we work with continuous rates, I just want to show you how to do those calculations. Just remember, okay, that the calculation is slightly different to when using discrete interest rates. Watch for that. Okay, so how do I value a bond? Present value of future cash flows, same old. So let's do the present value calc in year number one. It's future value, which is $5 times E minus the rate. The rate is 6.49%. Times the time period, which is 1, which gives me 4.6858, which you'll notice is exactly what I had before. Nothing changed in the actual present value calculation. Well, that's because I've adjusted the rates to make sure we get to the same answer. But the formula is slightly different to get there. And all I want to show you is how to do this on your calculators. Again, let's go. Let's clear everything on the calculators on off, and let's get ourselves going straight away into our numbers over here. Okay, over the page. And we put into our calculator. What's interesting about that calculation is we need to do it a little bit backwards. Never put your E button first, your exponent button first. That comes at the end. Okay, so what do? I go 0.0649. That's my interest rate I've now put into the calculator. Minus, because remember there was a minus before that. Okay, times by the time period. The time period over here is 1, so times that by 1 is equal to minus 0.0649. There we go. Everybody comfortable with that? There we go. You do that first. Now we go to the exponent button. What is the exponent button? The exponent button is second function, ln, or e to the x. What do I get? I get to a number of 0.93. What does that look very similar to? That's really just a present value factor, isn't it? Remember, 100% is 1. This is slightly lower because it's a present value of the future value of 1, 0.93. Don't forget to times it then by the 5, which is the cash flow. And let's do that times by 5, and I get to 4.68, which is the present value of the $5. Okay, and all I really want to illustrate to you over here, guys, is just be careful. A lot of candidates come short where they try and calculate anything to the exponent. The exponent button, which is really second function ln, is the last thing that you push. You do everything on top of the E first, and then you come down and you do push the exponent button after that. Okay, I will do exactly the same thing for the second year number 2, okay, which has got a rate of 6.86. Let's just do that quickly. I'll just show you that. Okay, so we go 6.86%. Okay, don't forget to make that a minus. Okay, now times it by 2 because I'm in my, oops, not by only by 2 because I'm in my second year. Okay, and I get to minus 0.1372. Now I can go second function, e to the x, I get to 0.87. Don't forget to times it by my cash flow in year 2 of 105, and there is my 91.5386. Again, same story. What is the value of a bond? The value of a bond is its present value. The present value is cash flow 1 present valued, cash flow 2 present valued, bond value of 96.21. The difference over here, guys, when I'm using a continuously compounded interest rate, that is, I need to use the logarithms and exponents components, and I've just shown you how to do that then on your calculator. And that's the real big difference then between the two calculations. But unfortunately, both calculations are a little bit manual. So be it. But still use your calculator. It'll still save you a bit of time than doing it completely manually. Okay. Last little thing I want to show you over here, guys, is yield to maturity. Okay. Interestingly enough, the yield to maturity is also called the yield, is also called the par. Okay, the par yield often goes by as well, also called the internal rate of return, the RR. Okay, what is this yield to maturity? We've spoken a bit about spot rates. Remember, what did we say about spot rates? Spot rates are those rates that we use to discount individual cash flows for individual maturities, individual years, because we've got to get the right discount rate, the right spot rate, the right zero coupon rate to be able to discount those cash flows for each particular year. The yield to maturity says, well, what did you make on this bond? In other words, the yield to maturity, or the IRR, is really an average rate, a par rate. Okay, as opposed to a spot rate, which is a specific rate for a specific year. Yes, I need to use those specific rates for the specific years or maturities for my present value calculations. But once I've done all of that, I can now go and work out what is the average rate, the average yield on this particular bond. That's called yield to maturity. And what I've done specifically, guys, is I've kept the numbers consistent. What you would have noticed from example 1 and 2, whether we did it, I adjusted rates a little bit, but whether you did it on a discrete basis or on a continuous basis, what you would have noticed is that the price of the bond, okay, is $96.21. Okay, that, and remember, that was really what, how did I get to the $96.21 from the previous examples? I worked out their present values per year using spot rates. Now I've got that, I've got my price. We also know we've got a future value on this particular a bond of $100. Okay. What else do we know? We know the discount rates. We don't need them now because I've used them already to get to my price. What I want now, I don't want spot rates now. Now I want average rates, yield to maturity, or RR. Okay. Now we can go and calculate that. I want to show you something very interesting. Okay. Let us move forward over here, not so far. Okay, let's have a look over here, and this is just stock standard time value money. Let's do it together. Let's clear over there, and let's clear my time value of money. Okay, let's put in the present value first. So this bond we know has got a price of $96.21. Where did I get that from? Well, remember, I've done all the calculations before for the present values in example 1 and 2. I now have that present value of $96.21. We can put that in. We know what is the future value of this particular loan. That's $100. And remember, you can see I put that as a minus future value. We know that this bond makes payments of $5 a year. So let's go $5 negative, and let's go payment. Okay. What else do I know about this? I also know that this bond 2N, this bond has got a payment period. That's a 2-year bond. Everybody comfortable? Now I go CPT, compute interest rate. Look what it gives me. To something very interesting. This gives me 7.099%. What is that telling me? Well, first of all, that is the YTM. That's the yield to maturity. That's also the par rate. That's also the internal rate of return, the IRR. Okay, so what have I done? Remember, once I've got 4 of the other inputs, or even if I had 3 of the other inputs, I could work out what my average return or my average rate on this bond is, or my RR, which is 7.099%. What do you notice? So if I had present value 96.21, I had future value of 100, payment of 5, and a number of periods of 2. What do you notice about this? And we're going to conclude with this. What do you notice about that 7.099% average rate? Where does it sit? Now you can see why I put the spot rates here. Well, year 1, the spot rate, the specific rate was 6.7, wasn't it? For the cash flow in that year. What was the cash flow in year number 1? 5. Little cash flow. Year 2, the rate was 7.1, the spot rate. What was the cash flow in year number 2? 105. So the most of the cash flows happened when? 105, they happened in year number 2 versus only $5 in year number 1. What's the difference in rates? 6.7 in year 1 and 7.1 in year 2. Can you all see why the average rate is so much higher to the 7.1 from year 2, and it's equal to 7.09, almost 7.1. Why is it so close to 7.1? Because most of the cash flows happened when? In year 2, when the spot rate for that year was 7.1%. Only $5 of cash flow happened in year 1 when it was at the lower rate of 6.7. This brings us to a conclusion of our particular video number 6. We had a bit of a look over here, maybe more of a lecture than so much of calculator work, but I hope everyone's gained from this in terms of bond valuation. This brings us to a conclusion in terms of our series, how to use your Texas calculator. This is video 6 of 6. I hope everybody has benefited from this and is now proficient and excellent at using the Texas BA2 Plus or BA2 Plus professional calculators.